Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Thanks for joining us, everyone, on our SCD call. It is October 24th. 2024. We've got the CEO, Alex Baluta, and the CFO, I believe, Michael Denny, Flow Capital Corp, FW.V on the Venture Exchange. Flow Capital currently trades with 30.8 million shares outstanding at 72 cents for roughly a $22 million market cap. Alex, thanks for joining us today. Michael, thank you for joining us. Looking forward to getting caught up. We've had John a couple times in the past. So as we were saying off air just a few moments ago, you're here to tell us I told you so. Company's done very well over the last little while. Record numbers. Stock's doing a fair bit better than the last time we spoke. So lots of good things to talk about. So listen, I'm gonna hand it over to you to sort of get us updated. But before that, make sure everybody understands what Flow is all about.
Will do. Thank you very much, Paul. And yeah, this is our third time here on your channel. I think you guys do a fantastic service, and congratulations to your success over the last several years. And appreciate you giving us the opportunity again. So thank you everybody for attending. My name is Alex Baluta, the CEO of Flow Capital. I've got Michael Denny, my CFO and partner here. Ticker FW on the Venture Exchange. Typical disclaimer, everything here is publicly available information. We are what's called a venture debt lender, or we compete and participate in the venture debt space. Venture debt is lending to high growth companies. So we help growth companies scale their businesses. If you think about it, or maybe to help explain it, we kind of fit between banks and venture capitalists. So venture capitalists take equity positions and they hold them for 6 to 8 to 10 years and hope that they get a 10x in that equity position. Banks will lend you money at 6, 7, 8%, but they need personal guarantees and asset-backed, assets to back the loans. We lend money to those growth companies that can't generally get a bank loan. However, they have a lot of equity invested in them. They're growing, and they need our capital to do things like extend their runway, for example, invest more in sales and marketing. I'll go through a case study here in a moment. So we're basically lenders, just like a bank. We are senior secured. We take senior secured positions in every one of our companies. And we're generally covenant light, minimally dilutive, although what's important to note, I'll explain a bit later, is that we do have warrant positions in over 20 companies now. And that warrant position allows us to get essentially unlimited upside on our warrants. And we like to take debt-like risk and generate what you'll see is equity-like returns. And so our internal tagline is for companies that have really nailed their value proposition. They're revenue generating, they know what drives sales, they know their customer profile. For companies that have nailed that value proposition, we help them scale their business. We're more flexible than bank debt, and we're much less expensive from a cost of capital perspective than equity. So that's what we do. Just to take a step back and tell you how we've done that, how well we've done that over the last 6 years is we've deployed over $73 million. Our average loan to value of our loan relative to the total enterprise value of our borrower is about 9.3% on average at the time of investment. Our annualized cash yield as of June is 19%. That's over the last 6 years. Our portfolio IRR over 6 years is 26%. Our loan loss ratio is about 1.4%. And it's important, the subordinated capital, really what I'm referring to is our equity. We're trading at about half book. Our book value, we have about $39 million of equity on our balance sheet. And that's important both because of the discount that we trade at, but also that equity provides a buffer and a cushion for our debenture structure, which gives investors, Michael will explain how investors can participate either by owning our equity or by owning our debenture, which is essentially retractable on demand or redeemable on demand by your choice. And that debenture is senior to $39 million of equity. So here's a case study of an example of one of our successful loans. So this is it. The blue line is a monthly revenue chart of a company in the software as a service space. We generally, our value proposition for growth debt really works in technology. I have a technology background. Most of the team has a technology background. This was a SaaS software company based out of the UK. In 2019, when the company was generating 2.7 million in revenue, we lent them $1 million. They used that money to grow. Later in 2020, when they were doing, they'd almost doubled their revenue. They were doing $4.9 million in revenue. We lent them an additional $2 million. So we were all in for $3 million in loans. And then a couple of years later, they were doing $7.6 million in annual revenue. We lent them an additional $3 million. So we were all in for $6 million. At the time, this was our largest loan. And then at the end of, post-COVID, there was a bit of a, they did phenomenally well, like everybody did in our portfolio. Our average revenue growth of our portfolio companies through COVID was over 50%. But there was a bit of a hangover post-COVID, where growth on a sequential basis slowed a bit, but continued to do well year over year. And at that time, they bought us out. The loan matured. They were doing about $9.1 million in revenue, and they essentially repaid our loan. And that was in December of 2023. So this is a perfect example of the type of investments we like to do. We get paid mid to sort of 15 to 18% yield, cash yield. We always take cash interest. We don't take PIK. And in this case, we own just under 2% of this company in equity, in warrants. And the first tranche of those warrants down here, when we lent them $1 million, the value of the company, I believe we struck those at about $10 million. The equity value of the warrants at the time was $10 million. So we really have two ways that we generate our IRR. And you'll notice that our IRR is above our interest yield. And that's one, through the cash interest yield. We do have some closing fees and some early prepayment fees. So there's additional cash bonuses along the way. But then we have the return on our warrant portfolio. And that can be fairly sizable. We've had some, one of our loans that I probably talked about the last time I was on here, it was repaid. It was a $3 million loan repaid in less than 12 months. And it was over 100% IRR on that loan because the company had basically hit a triple or a double. Not quite a home run, but a really strong return. And those wins that we get in our warrant portfolio help us generate stronger returns and make up for any losses that we might have along the way. So that's an example of the type of loans that we do. You'll notice we didn't give the company $6 million day one. That's inefficient for them. It's also potentially more risky for us. We generally limit our loans to 1x revenue. So in each instance, for example, after the second loan, we had $3 million invested. The company was doing $5 million in revenue, so we were below 1x ARR in terms of our loan relative to their revenue. So we invest in tranches to mitigate risk, and it's also better for the company. Go to the next slide. So I want to bring you back to our most recent Q2 performance, which was to June. On many levels, it was a record quarter for us. We had 1.85, just under 1.9 million in recurring revenue. That's loan interest income. That was up 5.7% sequentially from Q1 and up over 28% from the prior year. Our book value is just under $1.26. That was up 37% over 2 years. I'll show some charts on this in a minute. We had 283,000 in recurring cash flow. We've been profitable now for over 17 quarters. I'll show you a chart on that as well. And we generated over $1.4 million in free cash flow over the past 4 quarters. We had record total assets at just under 66 million, up 12%. And in the trailing 12 months, we had deployed $29 million in new investments, and that was a new 12-month record for the company. So this past Q2 was a record for us. And to be honest, it was actually on the back, hold on a sec, of 5 quarters of sequential revenue growth. So look, this is a bit of a complicated chart. Let me just quickly explain it. The white line is our quarterly recurring revenue. That's how much revenue we're generating. The dark green is our EBITDA, and the light green is our recurring free cash flow. So we've been recurring free cash flow positive now since Q1 2020, so 17 quarters in a row. You'll see from here in Q2 23, every quarter we've been growing revenue sequentially. And frankly, it's relatively simple math. You'll see in our press releases, as long as if we're deploying capital at a faster rate than we are having a return of capital through repayments of our loans, our revenue is going to grow. And so in some instances back here, we'd had redemptions or repayments of loans, and it took us a while to reinvest those loans. But along the way, we've been profitable the whole time. So this is a 4+ year history of our revenue, EBITDA, and free cash flow generation capabilities. This chart, again, a little complicated, but this is our 4.5 year book value attributable to common shares. So the top, the green lines, that's our assets. The gray is we have a redeemable debenture that Michael will talk to you about, is essentially our debts. Our net book value at the end of Q2 was $1.26 or 1,255. And the orange line represents our share price. Now you see the gap between our share price and book value had widened relative to the past. Now the shares have done relatively well since Q2. I think they're in the low 70 cents range now. So the gap has shrunken a little bit. But our long-term objective, we have an internal 5-year target of growing our asset base to over or in the range of $500 million. And we generate a net interest margin on every one of our loans somewhere in the range of 5 to 6%. Plus, we have a very large portfolio, or an increasingly large portfolio of warrant positions. So this is a very simple business. We invest in revenue-generating companies who've really nailed their value proposition, and we're giving them money to extend their runway, to accelerate their growth, to bridge to profitability. And behind us are the equity holders. And so we're senior secured in every one of our investments, and it's a good, can be a high growth business. We've got some comparable players in Canada that have scaled from where we are to over 600 million in assets and deployable assets. And what we've really been doing over the last couple of years is building our infrastructure in terms of deal origination, in terms of partnership for deal flow, in terms of financial partners. We've just signed a $15 million warehouse line of credit with a US bank. And it's been a slow but methodical process of getting the people in place, getting the processes in place, and getting the procedures in place. And all the way along, we've been profitable. So what is our typical credit box? Who do we lend money to? They're high growth companies, generally above 20% revenue growth rate. They must have a minimum of $3 million in revenue. It's primarily tech. Our client base skews to tech, though we do look at other, we're a little bit sector agnostic. We don't do real estate and we don't do primary resources, but we generally, so we'll look at services companies, we'll look at other creative companies, but they have to have growth. The other thing they tend to filter themselves out on is their asset light. And the reason for that is there's alternatives like banks or other funds that'll lend money at cheaper rates to asset heavy or asset rich companies. Our loan amounts are in the $2 to $10 million range. We invest in the US, the UK, and Canada. The majority of our investments are in the United States. The use of funds is growth, broadly speaking, but it could be, as I mentioned, bridge to profitability, around extension. There's lots of different uses of our capital. In terms of sponsorship, what that means is Are we only open to VC funded companies? The answer is no. We will do VC funded companies, but we'll also do founder bootstrap companies. And in those founder bootstrap companies, we can generally get slightly higher yield. So we're open to both. Approximately 60% of our deals are VC funded or VC sponsored. Now, if we do founder bootstrap companies, we do focus a lot on, we do an awful lot of due diligence. It usually takes us 4 to 6 weeks just to do our due diligence, but we really focus on governance, and the importance of having a true board of directors and true independent governance is very important to successful outcomes, we've found. We do what we call equity level due diligence. We need to know all the gotchas in there. We need to know what risk we're taking. We need to know how do we get out of investments. And so it takes a lot of due diligence. We also need to know that this company is on a growth trajectory, not just a sort of a one-off blip. Profitability is not required. However, at the time of investments, they must show a clear path to getting profitable within the time frame of our investment. And the typical terms, as I said, we're senior secured, mid-teens cash, and we take equity warrants equating to somewhere between 1% to 3% of the companies that we lend money to. And then I'll pause after this slide and hand it over to Michael. Michael will talk about our debenture. I'm just broadly speaking, why do investors choose Flow? Why would you, as a potential equity or share investor, look at us? One, recurring revenue. We have a recurring revenue profile. Two, we're cash flow. We generate cash flow. And we have a lot of upside potential in terms of our growth. I will say that, broadly speaking, the venture debt space is over $30 billion a year in originations. And players like RBCX, CIBC Innovation Banking, many other players in Canada and the US play in this space. Now, we each take a different niche in terms of risk return profile, but it is a very large multi-$30 billion market in North America alone. So we're a cash flow generating engine. We've been cash flow positive now. That's typo, I missed that. That's now over 4 years. We have equity upside in our portfolio. So it's not just yield. It is also about the warrants and the upside in the warrants that we can generate. Our track record is 26% IRR at gross level on our portfolio over the last 6 years. We have very good underwriting discipline. It's a 1.4% loss ratio over those past 6 years. We also, from a discipline perspective, are very choosy in who we choose to invest in. 1,000 leads a year, less than 1% are closed on. I will also say that even after signing a term sheet, we have a less than 50% close rate because we filter out, even when we've done a dance and they agree on our rates and we agree that we think they're a good company based on what they've disclosed. When we get into detailed due diligence, it's often we find it's different than we expected and it doesn't meet our quality threshold. And look, as a rule, what I tell my team and the partners in our business, it is so hard to make back $1 million loss at a 6% net interest margin spread on the rest of your portfolio. So we target 0 zeros. We're going to have challenging deals. That's the space that we're in. But we do our best to minimize those challenges. We do our best to work out of those with the companies and with our partners. And so far, we've been doing a great job at that. We have a conservative balance sheet. Our debt to total assets is about 36%. Stakeholder alignment is critical. I know it's important for you. It's important for us. Management and the board and insiders own over 24% of the equity. We own both our equity and we own our debenture, which Michael will talk about. And as I said, it's a very, very large market. So I'm going to pause there. And I know that, Paul, we're going to have questions, and maybe we can hold off on questions and I'll give it to Michael and let him just talk a little bit briefly about the 2 ways you can invest. One is our equity and the other is our debenture. Michael, over to you.
Okay, thanks, Alex. Let me just share my screen here.
Not seeing it yet, Michael.
Not seeing it yet.
Oh,
You should see it now, right?
Yep.
Yes.
Yep.
Great. Okay, let me just put it on slideshow mode. Okay. So Alex is giving you a very comprehensive view of our company. I'm just going to drill down and speak about one aspect of our business, which is our floating rate redeemable debenture, which is one way you can invest in flow as opposed to buying our common shares. So as Alex has spoken, we are a venture debt fund structured as a public company. And because we're structured as a public company, it allows us to do a couple of things that traditional venture debt funds can't do. You've seen the disclaimer before, Alex had one. So really the thing I want to speak to is the fact that venture debt's an attractive asset class. And Alex spoke at length about this, so I won't go into detail. But what I will say, which I don't think Alex spoke to, is there's two forms of venture debt that are common in the market. One is traditional venture debt, which is what our competitors or our complementary funds do. And then one is growth venture debt, which is what Alex and I do at Flow. So traditional venture debt really only lends to VC-backed companies. Usually the deals are large, over $10 million. A high coupon, generally no warrants, and they target a 12 to 16% return. What Alex and I do is we focus on growth venture debt, in that we chase companies that are founder-owned. We do smaller deals, under $10 million, but more than, say, $2 million. We get a high coupon, as Alex has spoken to, but we also get warrants. And because we get warrants in those companies, our historical IRR since inception 6 years ago has been 26%. And generally, people that do what we do make somewhere between 20 and 25%. So these are points that Alex has already made, but we entered the market in 2018. We have 13 active deals. We exited 10. We're always senior secured. The 26% return is amazing because you have to remember, our portfolio is senior secured. They're not equity investments, they're debt investments. We're making a 26% return on a debt portfolio. That's an equity-like return. And so what we've done for investors such as yourselves is we bifurcated our returns into two vehicles. For those investors who are looking for a higher return, are willing to take the volatility associated with the equity markets, they can buy our common shares. Now, Alex spoke at length about our common shares. But for those investors that like what we do and see how consistently profitable we've been, those investors can consider investing in our debentures. They're floating rate, they're redeemable at par whenever you want, and currently they yield 9.75%, which is an attractive return. And I really want to say there are three reasons for investing in our debentures. The first one, obviously, is 9.75 is an attractive return. But it's not a return based on the performance of our portfolio. It is a return that we've contracted and agreed to. We're going to pay you the Bank of Canada rate plus 5.5%, with a floor of 8 and a ceiling of 12. And regardless of the performance of our portfolio, that's what we're going to pay you. So it's predictable. Now, it's redeemable at any time on your options. We'll need 30 to 90 days to pay you out. We'll try and do it within 30, but contractually, we can keep it out 90 days. RSP, TSF.V, any registered plan eligible. We do impose a 5% trading fee because we don't want people to park money with us short term. If you want to join us, we'd like you to keep the money with us for at least a year. And it's also available in US funds for those of you that are snowbirds and want US income, which is currently paying 10.83 because the Fed funds rate is higher than the Bank of Canada rate. That's the first reason, 9.75. The second reason is we have a 1.8 times interest coverage ratio. That is the cash that we're throwing off that can be used to pay the interest on the debentures. So the rate, the monthly payments you get on our debentures is relatively safe because we have $1.80 in free cash flow for every dollar we owe the investors on their debentures. Even if our profitability, which it shouldn't, but even if our profitability was dramatically reduced, we still have more than enough cash flow to pay the interest on the debentures. And the other side of the coin, and the third reason, is the principal's relatively safe because we have a 2.6 times asset coverage ratio. If you look at the size of our portfolio of loans, it's over $60 million. And yet the debentures are only about $25 million. So again, as Alex mentioned, we have about $40 million in shareholder equity, which protects the principal of the debentures. Even if our loans had huge write-offs, half of them go to zero, we would still have more than enough money to pay back the principal on the debentures. And that's really 3 good reasons why you should consider adding Flow Capital's debentures to your income portfolio. There's an attractive yield, which is contracted and predictable. There's a 1.8 times interest coverage ratio. And then thirdly, we've got 2.6 times asset coverage ratio. And as I said, you can get out anytime on 90 days notice. Now, I have all kinds of background information, as Alex does, and we'd love to open up for questions. But one person did type in a question, which I thought I'd just answer directly here. What I have in my presentation here is a list of the 23 loans we've made. And you see they're all here. There's nothing being hidden. And on the far right-hand side, you can see the IRR that we've earned on our loans. As Alex spoke to, we've earned 26% on our loans overall. But look at the returns on each individual loan. They're almost consistently in the mid-20s. We had one superstar, which made 124%. And we did have some losers. This one, -12, this one, -54, this one, -3, and this one, -43. So we do make mistakes, absolutely. But the great thing about our business is the one average loan in the mid-20s is pretty consistent. And after that, with that, I'll turn it over to questions.
Perfect. Well, thanks, guys. Yeah, as the boys just mentioned here, if you've got questions, please use the chat function and I'll ask the question. I've got a couple questions just in general here. The market, I keep thinking that so much of the market is dependent on just access to capital in general. Markets get good, there's more access to equity. Markets get poor, probably tighter capital conditions out there. In the market right now, from your clients, are you seeing more demand, less demand, steady demand? How can you sort of describe the current customer demand right now?
Yeah, so thanks, Paul. It's a great question. Companies can come to us even if they have an equity alternative. In fact, one of the reasons they come to us is to postpone that equity alternative, be that public markets or equity from the form of venture investment. We are seeing the stat I heard the other day is there's now 4,000 public companies down from 8. We're seeing a general erosion of public markets, IPO markets, I think, as companies try to stay private for longer. Broadly speaking, we're in the private credit space, which in Canada has some bad examples of bad apples and bad players. But companies staying private for longer is a thing. Now, those private companies can still get equity investments and often do. As Michael said, we focus on those that aren't venture sponsored, but we do have venture sponsored. So yeah, we've found that we're uncorrelated in terms of any broader, like, as I said, if anything, we're reversely correlated, but through COVID, our companies generated 50+% revenue. We're just, the companies can have different cycles. Companies can have different reasons why they need the money. Companies can have different intentions. Some don't want venture capitalists on their board. Some don't want the overhead that comes with a venture investor in terms of shareholder agreements and other types of issues. So there are literally millions of companies out there that are within our broad target market. We just need to find a few of them, and the reasons why they might take us versus equity are varied. But generally, we're minimally intrusive. That means we don't take personal guarantees. We may take a pledge of shares. We may need to ensure that we protect ourselves and align the behavior of our management teams. But we're minimally intrusive. We have covenants, and they have cash flow covenants that are usually based on their own forecasts, among other things, or revenue growth covenants. But we let them do their thing. We want to find the management teams that have, again, nailed their value proposition and just want to grow their business. And we want to come along for the ride. So we are an alternative that arguably might be more expensive with a headline interest rate of 16% than something that they might be able to get on an equity basis. But they may still choose us for any number of reasons. So this isn't a shortage of opportunities out there. It's actually, the challenge for us is finding those opportunities by developing our referral network. And we've been investing in that now for 6 years, and it continues to get better all the time. More and more deals come over the transom. But I hope, Paul, that answered your question. Like, there's just so many companies out there that need growth. And look, the reason we focus on growth is sorry, my one last is because generally those companies that are growing, they need capital to grow. I'll pause there. Go ahead, Michael.
Yeah, I'd answer that, Paul. I'd answer that question a couple of ways. First of all, I hope you sat up in your chair when we quoted 26%.
Oh yeah, absolutely.
Okay, now look, like, that's unnatural. In my view, that is a super normal return. We are being compensated by our borrowers in excess of the risk associated with their loan. There's actually been academic studies showing the default rate on venture debt is extraordinarily low compared to the return they're getting. Like we're good guys, we're hard workers, we're smart, but we're not geniuses. And that IRR chart I showed you shows that we're not lucky. We didn't get like a couple of 200% returns and a whole bunch of dogs. The fact is, there is very little capital for the number of companies that are chasing this. There's very little capital available for companies that need this type of capital. And we know that every single day, because when we put a term, you've got other clients who are, traditional companies, when they need to raise debt, they call 6 banks, they get 6 term sheets, and then they choose the best term sheet and they compete, they play the term sheets off, right? A great number of our clients, they come to us. We give them a term sheet and then they start negotiating with us. They don't shop the deals because they know there's very few providers like us. There's only really, in Canada, I don't think there is anyone that competes directly with us, and there's probably half a dozen in the States. So when people deal with you and they don't shop your term sheet, you know that they're extremely happy to get your offer and they want to negotiate with you. And that's a much different market than traditional private credit, where all the term sheets are all competitive and it's all shopped and everyone's rates of return drop. So I think the answer to your question will be, as you follow us over the years, if our 26% goes to 24%, that goes to 22%, that goes to 20%, that'll be an indication to you that the market is shrinking or becoming more competitive. But watch us. The neat thing about us, we're a public company, unlike a lot of other private credit funds. So you see our quarterly numbers. We publish our IRR. If our business gets more competitive, you're the first guy to see it for the public markets. Sorry,
No,
I think I may have over-answered that question. But
no, I think you did a great job.
I am so used to extremely competitive. I was in private equity before I joined Alex here at Flow. I'm used to guys like, it's so competitive out there. And then here, Alex Baluta found this little niche that's not terribly competitive. And we're able to exploit that. And you've seen it in our financial returns.
No, perfect. No, well, Alex, you mentioned sort of this is kind of the challenges, accessing deals, or I guess, increasing your deal flow. What other challenges do you face running the business right now?
Access to capital. We're trading at a discount to book, and obviously we're not going to do an equity issuance at that level. But there's probably 3: finding the good deals and continuous deal flow, working with some of the deals, as they go through changes. And one of our most successful deals ever, that's actually not on our IRR chart, was a company that had gotten into trouble, and we calmly worked with them. And then through COVID, just to give you an example, that company when we invested in them was doing low teens revenue. A couple of years ago, they did over 25 million in EBITDA. Now they had a COVID bump, but it pays us to work with our companies and make sure they have successful exits. So one is finding deals, 2 is working with our companies, and 3 is access to capital. It's one of the reasons we're here. It's one of the reasons we've bifurcated our loans. For those that want yield, we've given you a yield product. For those that want capital gains, love to have you as equity investor, and many of you can and will take both. But there's the other thing that's been a challenge is finding really, really good people. And I may have mentioned this before, but I absolutely love our team. Just a young, good, great group of hardworking individuals who are passionate about what we do. I'll answer Paolo's question. Yes, Michael and I own stock. Not only that, we have what's called an ESPP, Employee Stock Purchase Plan. We top up our employees' contributions. They can take 10% of their gross salary, put it towards stock payments, and then we top that up by some amount to encourage them to buy more stock. And I think every single one of our employees and past employees has participated in the ESPP, the Employee Stock Purchase Plan. So we look, if you think of the equity at the bottom of our stack, right, our capital stack, you know, when we as a management team and a board and employees own, you know, 25% of the equity, you know, we're aligned because any losses that we have are going to hit that equity first. So yeah, it's finding the right people and hiring the right people has been a challenge, but I think we've kind of won the lottery. We've got some amazing good partners, and we're growing our business, and we're hiring we have a couple more job applicants out there, and sometimes it takes us 6 months to hire because we want to find the right cultural fit, the right skill set. So those would be the 4 challenges.
Gotcha. Now,
I'm not worried about, Paul. Sorry to interrupt. I'm not worried about changing interest rates. I'm not worried about, you know, the volatility of the equity markets. None of that matters to us. We're just looking for great companies.
Makes sense. I mean, I saw the list of all the companies that have done well. You've had a small number of companies that didn't work out for you. What happens when something doesn't work out, when they can't make their payments, or, you know, they're in trouble? What is a company do you guys do to mitigate sort of that damage to you guys?
You know, there's procedures, right, of notice of default, events of default. But as I mentioned earlier, we work with them as far as we can, as long as we can. We did have one example where we put a company through an in and out bankruptcy process where, here's the importance of being senior secured. Probably about $4 million of debt and equity below us was crushed to zero. We ended up owning the company. We then had new investors refinance the company, and that didn't work. That worked out, but not as well as expected. And then that entity was eventually sold. So through a couple of iterations, a sub-$1 million investment, that's lower than we'll do these days. We end up owning some shares now, both pref shares and common shares, in a company called JobGet that is a company that has $23 million in ARR, last I looked. So even through what was a bankruptcy in Canada, we ended up owning the equity through where essentially we sold the technology and the then revenue run rate in a larger company. So these are rarely zeros where you get nothing in return, and even then we've got several years worth of interest. So we have a playbook. We work hard with them. We give them a little wiggle room, but not lots. Oftentimes you'll see management putting in more money to get them over the hump, whatever that might be. But you have to be patient. That's a lot of what I do is, I shouldn't say a lot of what I do, but it's one of my primary responsibilities is working with those companies that need a hand. And look, I've been investing in small, high growth companies now as a top ranked tech analyst in Canada for approaching 30 years. It's what I've done.
Yeah, let me put a similar spin on that. This is secret sauce. This is what makes our sector, venture debt, very much different than private credit in general. And that fact is software companies, which is the majority of our investments, are really easy to sell. So put yourself in the shoes of a private credit guy who lends money to a manhole producer in Winnipeg. And the manhole producer in Winnipeg gets into financial difficulties, and they got to work it out, and they got to sell the business. Do you know how hard it is to find a buyer for a manhole company in Winnipeg? Like at any price. Now, contrast that to the fact that Alex invests or loans money to a software company in Winnipeg that gets into difficulty, and we have to put the business up for sale. Do you know how fast that company gets sold? We get bids for that company from Silicon Valley, from London, England, from New York, because software companies are very fungible. Other software companies want to buy their assets just for their revenue or their people or their angle or their brand. So that is the secret to why venture debt has a very low default rate. And that's not just us, Paul. That's every venture debt provider. They generally can get off the asset by putting it up for sale far easier than a traditional company. And that's not because we're geniuses. It's just because we act in a sector which is very aggressive on M&A. Businesses will get into trouble, but we'll force a sale of them.
Yeah. That's interesting. I wouldn't have thought of that, but it makes sense. Absolutely. It's so much easier to transfer digital assets than it is to transfer,
company's losing money,
things
but
like that.
The acquirer doesn't care the company's losing money. They just want the revenue. They'll fire all the employees and move the technology to London, right?
Yeah.
And we'll get our money back.
Makes sense. Guys, looking at some of the charts you showed there, the stock trades a significant discount to book value. And I know, we talked off air, you bought a significant amount of shares back in your history. When does share buyback become a better use of capital than the 26% sort of IR you're getting right now? When does that become a big question?
Yeah, thanks, Paul. So we've bought 16 million shares, spent over $6 million over the last 6 years buying back stock. So we've bought back a third of our total shares outstanding. Given that our average purchase price was 38 cents, book value is now $1.25. It's been a wonderful return. We will stop when our shares are more fairly valued. And I'll be honest, there's several examples of companies like us that trade through book. And they trade more on a growth and an earnings growth basis. We have a long-term the capacity, without trying to make any forecasts, but the capacity to generate very strong return on equity through this business model and have consistent growth. It's there. It's a really great business. So we wouldn't obviously buy shares when they were above book, but to be honest, never say never, right? All I know is that we've found that it's been a great use of our funds along the way. We haven't spent that much such that we've impinged on our ability to make investments. If you want to look over our quarterly history, on average, we carried a balance of between $5 and $9 million of free cash on our balance sheet. That's a little lower now as we've started to invest in more quickly in terms of our cycle of deployment. But it's been a great use of our funds. And we'll keep doing it as long as it generates a meaningful return for us and our shareholders.
Gotcha. I just a couple more questions as we get ready to wrap up here. What's, as investors watching you guys, what do you think are the most important metrics or catalysts that we should be paying attention to?
Deployment of capital. Revenue growth, free cash flow growth. Pay attention. Q3 is coming out in a couple of weeks, maybe a month. Again, if you want to dissect our business, just look at the number of deals that we put out, the number of deals that come back in, and consistency, just consistency of growth. We ourselves feel that we fit squarely in that growth bucket category, where we've had 5 quarters now of consistent growth. We've built the team, we've built the network, we've got the capital. We need to raise more capital. It's to continue to deploy. But it's, the KPIs, you could drill even deeper and look at net interest margins, those kind of things. One of the things that we've done internally is we've built our own dashboard, our own set of KPIs. We have team meetings where we review the KPIs on a weekly, monthly, and quarterly basis. And so and as I said, we have everybody as a shareholder. So I think more broadly though, and just look at our deployment rate and I'm not going to say that we're going to have every single quarter as a sequentially growing revenue quarter, but that's my objective. But we will have dips as we deploy capital, but the general trend should be up into the right in revenue and similarly with free cash flow.
And then is there anything we missed? Is there anything that if we haven't missed anything, how about a key message? What do you want to make sure everybody walks away with today?
Please call us.
Please.
please call. Please
Give
feel
Michael a
free
call.
to pick up the phone and call me. I can talk about this business for hours. I can drill down into anything you're uncomfortable with. I have rarely seen a small cap company that is consistently profitable, trading at 60% of book value.
Yeah.
So for all you guys on the screen that are like, Benjamin Graham fanboys, you like to look at our stock and look at the book value, look at the share price, and explain to me, call me and tell me why you're not buying it. Doesn't make any sense. Doesn't make any sense.
I love that challenge. I challenge everybody to call them and give them a reason. Exactly. Alex, anything you want to add to that?
No, I really appreciate your time, Trevor and Paul. And honestly, you just call us at any time if we're launching a new website. It'll have a new look. It'll have a little bit more about the value proposition. Yes, that's Tangible Book brand. Hi, Brandon. So yeah, just appreciate the time, and just I guess the only other word is keep watch how we perform. We've done, we were here maybe 3 years ago, a year and a half ago, and
Yeah.
I'll come back in another year and a half, maybe sooner. And
You'll be telling us the exact same thing. I told you so. Yeah.
Yeah. So
I love
really
it. Okay.
appreciate it.
Awesome. No, I appreciate it as well. Okay, we've been speaking to Alex Baluta, CEO of Flow Capital Corp, as well as CFO Michael Denny. Guys, thanks as always for joining us, and look forward to catching up in not too distant future.
Thank you very much.
Love to talk about our business. Thank you very much for the opportunity, Paul.
You got it. Thanks, guys. Bye for now.